I know what you're saying when you read the thumbnail and the title. Jerome, our bro from the Fed, designed that the markets are crashing, the markets are rotating, the markets are cooling off, the stock price is falling, and yes, it's, I think, the most sophisticated answer to what is happening. But let's dive first into what is happening, because some people, they understand it, but they then really don't. So let me just summarize it and explain it very, very, very simple. So imagine the following. Jerome Powell is the chairman of the Federal Reserve Bank of USA. Now he has the opportunity and tools to put money into the market, print money, and rise the interest rate where banks, companies, and so on can rent the money or get the loan for the money. So as you can see, he can actually, at some degree, quite steer the value of money. And this is actually the little bit of a concern on the market, okay? Because you can imagine the inflation that is coming on because the market is just flooded with money, right? Now, what is actually going to happen is when the bond yields, the 10 years are rising, it's another sign that maybe the interest rate go higher comes a little bit closer than we thought. And these two factors, the inflation and the fear that the interest rate hiking comes a little bit a year earlier, gives the market a little bit of fear. Now they can say, hey, you know what, we don't see inflation. This is somehow what he's saying, because think about it. The economy is recovering, but still it's not like on the same point where it was, right? Plus, people don't get the, let's say, increase in salaries, which is also a big inflation factor over time, and so on and so forth. So, on the other side, he has also the tools, and this was a little bit expected to address the elephant in the room, that Jerome, at his last interview last week with the Wall Street Journal, will say, don't worry about the rates, we are watching it, and we are buying, long-term, 10 years, 20 years bonds, so the bond yield will be controlled. But he didn't do it. So the question was, what is the reason for that? Why he let the market just run? They have all the tools to manipulate this, to stabilize that. But then I watched several hours of footage and everything, and did some research on the past and everything, First, I need to say I made one video where I explained that I think that interest rate hike will be one of the reasons why we can see, a market downturn or even a crash like we did in 2007 and 2000. If you want to see this video, make sure to click this thumbnail on my channel and you will get all the information. As you can see now, exactly this is happening what I said. Just the idea of higher interest rates earlier than 2023 is absolutely giving the market, a very bad couple of weeks, right? And that's normal, that's economics, right? Because especially the tech sector or growth companies which are specialized in, for example, in America or USA, are very dependent on cheap money, because growth is the number one factor for those companies. So you can see also the American market is also went much lower these days than, for example, the European market, where more of value stocks are the main part of the indexes. Plus, you can see it the same way in Nasdaq versus Dow. While the Nasdaq lost a lot of percentage points, the Dow went almost on a new record high. So, here's also a rotation in place going on. But the most important part here is why Fed Chairman Jerome Powell let it be. And the most interesting thing that I could find out, and I'm sharing here with you, is that think about what happened to the market over the last couple of months, right? Since the health crisis and the lows in last March, the market went absolutely nuts. I mean, not only stocks, growth stocks, specs, new IPOs, altcoins, bitcoins, NFTs, everything that give just a slight idea of return was absolutely inflated, and people were crazy. You know, we had 4 million new investors coming to the market, you know, trading on margin. So the market got just overheated, and I think this is the beauty about the market right now, that everything cools a little bit off. Everybody was saying like, okay, maybe it was not so good to buy stocks on margin. It was not so good to invest so much money into options. It's not so good to go in and out of speculative stocks like GameStop and so on. And I think this is obviously also one of the responsibilities of someone like Jerome Powell, to see the market and say, you know what, let's do nothing for a while. Let the market a little bit come back. Don't inflate too much, because as faster, you know, it inflate, as more you can just dive right into the red numbers. And obviously this is a little bit then of a concern for the Fed. But at many times, and I studied, you know, the last crashes very intensively, was always, you know, the Fed playing a big role. So make sure to watch the other video. And if you want to, you know, have this knowledge about, you know, what to do in specific this challenging times and recovery times, and why recovery times are actually the times where you can make the most money, then maybe you check out the X10 masterclass, which I created. It's an online course, so you can learn about stocks. You can also, if you are like already good in the topic, there is also the 10x mentality, how to find those stocks. I think it's a great value, and you will get also lifetime access to our Discord chat, where we talk about stocks 24 hours of the day. I really love it. It's a great community. So finally said, I think it's really interesting to have this persona, and Fed chief Jerome Powell is, I think, playing exactly this game. I didn't saw anybody else talking about it in the finance world of YouTube. So I'm thinking that not everyone gets this, okay? But if you are thinking more and more about this, it makes sense, right? I mean, the market just gets so crazy, going up and up and up, that he said, okay, you know, we can't do this anytime, right? So let the market just cool down a little bit, and then, you know, we can say, okay, we will do this and that, or this steps. And I think, you know, maybe already on the 17th of March we will know more, because the Fed chief cannot talk about the monetary policies or anything related to that until the next Fed meeting, which is, you know, like kind of a lock-up phase for him to talk about. So there is no appearance, and we need to be a little bit more patient until the 17th of March. But then we might know more which policies are going to be installed into place, and maybe will give the market a little bit more of stability and build a nice bottom there for us investors. However, you know, with that said, I think you should really listen to those people that, you know, having done a great job by investing money into hard times and into great times. And therefore I would love to end the vlog with a snippet of Peter Lynch talking about some stocks.
When you were actively managing money, you presumably were under the same pressures as other fund managers to show performance results. Right. Did that incline you to sell too quickly sometimes?
Well, I think my greatest mistakes are, I mean, you know, it's funny, on a stock, all you can lose is 100%. I've done that. But your great mistakes is selling a good company, and then it doubles, then it triples, and it quadruples, because you make a lot of mistakes. And so those ones that go up tenfold, I call them the 10 baggers. So some of my mistakes are just saying, oh my God, this stock is too high, and I was wrong. And you had to figure out, what inning am I in this baseball game? I sold Toys R Us way too early. It went up 20-fold after I sold. I did the same thing at Home Depot. Those are probably my two greatest mistakes I ever made.
When should you sell?
Well, you ought to find out why you bought a stock. If you're saying if it's a cyclical company and they're doing poorly and they're doing awful, you wait till things are getting better and they're doing terrific, and then you sell it. But with a growth company, you have to say, Walmart's case, 10 years after they went public, you could have bought the stock and made 500 times your money. Because they still are only in 15% of the United States. And they could say, why can't they go to 17? Why can't they go to 19? Why can't they go to 23? So for the next 4 decades, they went around the country. So you have to say to yourself, in this stock, I have a 10-year story, a 20-year story. You ought to be able to write that down and follow that. And that's what I do with the company. And that's your decision. That's how you sell it.
We have a novel element for many investors today in the trust issue.
Yes.
We also have security problems that we didn't traditionally have in America. Have they changed the way you pick and believe in stocks?
No, you still buy a company, and you buy a company to grow. And if it's a textile company or it's an electronics company or software company, you better understand what they do. And if they do well, the stock will do well, no matter what happens to the market. If the Dow Jones today was 1,000 or 500, you would have made a lot of money in McDonald's. You would have made a lot of money in Johnson & Johnson. You would have made a lot of money in Gillette. These companies' earnings have gone up a lot the last 30 years. And if the market was 50,000, you would have lost money in Burlington Industries. I recommended that in 1969. I think it's gone from 34 to 2 with no stock splits because the earnings have been terrible.